Net present value, which we also call as NPV, is one of the most important and valuable or most appropriate method for investment appraisal for any project appraisal. How do we calculate that? For any particular project, you have cash outflow, which is your investment, which is made today, for example, and then you have cash inflows, which are coming in the future period from that particular investment. So you discount all these cash flows. So you've got cash outflow, you've got cash inflow, you discount all of them. And some of them are positive cash flows, like cash inflows are positive, cash outflows are negative, and then you add them up, and whatever is the sum total, that is called net present value. So it is actually, the concept is that you find out the present value of the cash flows. You find out the present value of all the future cash flows, which are either inflows or outflows. And then, because some of them will be positive, some of them will be negative, so you must add them up. And then whatever is the answer, that is called present value, means net present value, because you have added them up. So whatever is the net amount. So it says that net present value of a project is the value obtained by discounting all cash flows, outflows, and inflows by a chosen target rate of return. Now, of course, when you have to discount them, you need to have a discount factor. And that discount factor we are calling as chosen target rate of return. So generally, this is actually WACC, weighted average cost of capital. We will learn what is cost of capital, but whatever is the cost of capital of an organization, whatever is the WACC of an organization, you discount the cash flows always with the cost of capital. I don't want to go into details of cost of capital at the moment, but because we have discussed this word here, so a very short answer is that WACC, weighted average cost of capital, you have equity in a business and you have debt in a business as a source of finance, okay? And debt has a cost. Debt has a cost because you will borrow it from someone and you have to pay the interest. Similarly, equity also has cost because when somebody invests money in the business as a shareholder, they also need some returns. So you give them returns here. This is a fixed percentage. This is the rate of return. And this is called cost of equity. And this is called cost of debt. And the average of that equity and debt, because you will have some equity and some debt, the average is called weighted average cost of capital. This is actually, in simple words, if a business is using money, so this is the cost of employing funds into the business. This is the cost of using funds in the business, because the business will attract these funds by paying some return. So whatever is that rate of return, that is called WACC, that is called cost of capital, and discounting is always done with WACC. So discounting cash flows to their present value means that the flows occurring at different times can be validly compared. Why do we do discounting? Because you might be getting 5K here and you might be getting 5K in year 2, and then you are getting 5K in year 3. Now, you cannot compare this 5K is not equal to this 5K because this is happening in year 1, this is happening in year 2, this is happening in year 3. And a dollar today is not equal to dollar tomorrow, because money loses value with time. So I cannot compare this 5,000 with this 5,000 or with this 5,000. They are not equal. So in order to compare them, what we need to do, we need to discount all of them to times 0. We need to discount all of them to times 0. We bring this value here, and that will be called the present value. So we need to find out the present value of 5,000 in year 1. And then we need to find out that what is the present value of 5,000 from year 2, or what is the present value of 5,000 from year 3. So money loses value with time. This is the basic idea. This is the basic concept. And then it says that if the net of the inflows and outflows is positive, the project is worthwhile as the investor will be richer. So because this is a positive inflow, maybe this 5,000 will be called as 4,500. This 5,000 will be called as 4,200. And this 5,000 probably is 4,000. So you will add up these three cash inflows. This is like 12,700, which is positive. You might have invested some funds here, which is a negative cash flow, and maybe you have invested 10,000. So that is 10,000 negative. So when you will see, okay, 10,000 negative, 12,700 positive, answer is 2,700 positive. If it is positive, you say that let's invest in the money. So what it says that you invest 10,000 today, which is a cash outflow, and then you will receive 5,000, 5,000, 5,000 for the next 3 years, which is 15,000. But the present value of that 15,000 is 12,700 in terms of today. So you are giving away 10,000 today, and what you are receiving, the present value of that is 12,700. So as of today, you are $2,700 richer. You are $2,700 richer. Your money, has, you have created value for the business. If the NPV is negative, on the other hand, then the project is not worthwhile and should be rejected. So NPV, we call it as a decision-making criteria. NPV is a decision-making criteria. We say that if it is positive, you are going for the project. If it is negative, you are saying no to the project. Even if it is $1 positive, you still say yes. Now, why? We will discuss it later, but theoretically, even if the NPV is just $1 negative, positive, you might be saying that, sir, I'm investing $100,000, and in the end, I get only $10 positive NPV. Is it worthwhile to get $10? No, it's not $10 actually. NPV might be $10, but what you are really getting is a different amount. We'll discuss it later. But theoretically, even if it is $10 or $1 positive, you should say it yes at this point. Now, this is the financial side of that. We are not talking about the other strategic reasons or some qualitative factors about investing somewhere or not. But if we talk about quantitative analysis, if the NPV is positive, you have to say it yes. If it is negative, you might say it no. Not might, you should say it no. So simplifying assumptions in NPV before we start. Now, NPV is a very complex topic. We have just started, and it will continue to more details as we move on. And of course, we are going to do some long questions for that as well. So first, let's make some assumptions clear. Number one, a cash flow incurred at the beginning of a project now, it occurs in year zero. The present value of $1 now in year zero is $1 regardless of the value of R. R was the required rate of return, was the WACC. Now, what it is trying to say, remember in your NPV thing, your project's timeline is always like this, where you have, this is number one, which is year zero. You call it year one, you call it year two, and you call it year three, and so on. Investments are made today. Whenever you say now that a cash flow incurred at the beginning of the project now, we say that if you make an investment today, or if you make an investment at the beginning of the project, it means that you are making an outlay here. You are making a cash outflow of say 100K in time zero. And like I said before, that time zero means year zero. It is not a full 1 year. It is actually a symbolic time period, which is the investment period. So if I make my investment today, time zero is not 365 days. If I put $100,000 in business today, I've already invested. From tomorrow, year one will start. Year one is only 1 day. It could be 1 day. So year zero is the symbolic period of investment. It is not 365 days. I invest money today. This is year zero today, and it finishes. From tomorrow, the year one will start. And year one is a full calendar year, which is 365 days or 12 months. Okay. So whenever you put it here, this investment today, in the beginning of the project, you are putting it in year zero. And the discount factor of year zero is always 1. Always remember the discount factor. So you say, okay, if I put here 100K today, so this is my investment outflow. What is the discount factor? The discount factor will always be 1. Why it is 1? Even if whatever is the WACC, because when you will find out the formula for discount factor, which we already have discussed before, even if you put the formula, your discount factor formula was 1 over 1 plus I power n, which is 1 plus, let's suppose your discount rate, your WACC is 10%, you will call it 0.1, and then you put bracket power n, power is 0. So anything raised to power 0 becomes 1. Anything raised to power 0 becomes 1. So it becomes 1. So the discount factor for the time 0 is 1. So it means that the present value of this 100K will remain 100K. This is what we are saying in the first assumption. The second one, a cash flow occurring during a time period. So this was beginning of the time period. So if it is beginning of the time period, we put it here. But if the cash flow is assumed to occur during a time period, which means here or here, this is supposed to be occurring at the end of the period. So we assume that it will be here. For example, they say you that the revenue for the first year is $40,000. Now, when I say revenue for the first year is $40,000, so probably this revenue has occurred evenly throughout the year, January, February, March, April, May, June. This revenue you are generating during the year. So it could be in any month of the year. But you will assume that it is occurring at the end of the period. Whatever cash flows occur during the period, you will suppose that they are occurring at the end of the period. Okay, so that you can discount them with year one. So then I say this is year 0. In year 1, I got $40,000 positive cash flow. And this cash flow is occurring at the end of the year 1. What we are saying, if anything happens during the year, you take it, assume it that it is happening, because like a conservative approach, you say that, okay, this is at the full year collection, I will calculate at the end of the year. And then you will use the discount factor for the second year for 10%, which is 0.909. And that makes me whatever 40,000 into 909. So this is the second assumption, that during the year cash flows are assumed to occur at the end of the period. Then we see another assumption. It says that a cash flow at the beginning of the period, is assumed to occur at the end of the previous year. Example, a cash outlay of 5,000 at the beginning of year 2 is taken to occur at the end of year 1. So if in some situations they tell you that you are investing some money at the beginning of year 2, or this is actually beginning of year 3, at the beginning of year 3, this is beginning of, because this is year 3, and I'm receiving or investing some money at the beginning of year 3, you should assume that it is happening at the end of year 2. So 1st January, it is just like this, that 1st January 2022 is actually the same thing as 31st December 2021. So whenever they will say that at the beginning of the 7th year, so you should assume that it is end of the 6th year. Why do you do this? Because you cannot discount beginning of the 7th year. So beginning of the 7th year, 1st January 2022 is actually the same thing as 31st December 2021, and then I will discount it from there, the full year. This is another, assumption which is there for the ease of calculations. Now, there is one question which we very simply consider. A new machine will cost $50,000 and will produce net cash inflows. So 50,000 is your investment cash outflow as of today. And then you receive inflows as 20,000, 40,000, and 25,000 in year 1, 2, and 3. And the machine can be sold for $10,000 at the end of the project. This is an additional cash flow in the last year, where you are selling, disposing of the machine and getting a residual value or a scrap value of $10,000. So you are actually getting 20, 40, 20 in year 1, 40 in year 2 you receive, 25 you receive in year 3, and also 10 you receive in year 3. Using the NPV method and a discount rate of 10%, is the project worthwhile? 10% is the discount rate. So let's make a table very quickly. What happens that initially you have your year 0, 50,000 is your investment, which is cash outflow. Year zero discount factor is always 1. We just discussed it. So present value is 50,000 is the discounted cash flow. This is called DCF, or you can call it present value. Okay. I'm not calling it net present value. I'm calling it present value. So this is the present value of this. Then you have 3, year 1, year 2, year 3, 20, 40, 25. And the scrap sale is also in year 3. And these are the factors. And how did you get this factor? 909, 1 over 1.1 power 1. This is for year 1. This year, year 2, you calculate as 1 divided by 1.1 power 2. Year 3, you will calculate as 1 over 1.1. 1.1, because 0.1 is 1, it is 1 plus R. I have got a discount rate of 10%, which means 1 plus 10%, which you can say 1 plus 0.10, which you can say 1.1. This is how I say 1.1. This is power 3. So this will be power, these two will have the same discount factors. Now, when you make, now you've got a $50,000 negative cash flow, and then positive cash flows are 18, 33, 18, 75. And when you make a sum total, it is giving you 27,000. Now, remember, this is the present value. This is the present value of year 1. This is the present value of year 2 cash flow. This is the present value of year 3 cash flow, present value of year 4 cash flow. And the sum, and some of them are negative, some of them are positive. And the sum total of them is called NPV. I'm not calling it PV now, because these are the PVs. And this is the NPV, net present value. Now, because it is positive, so you say, I'm happy to go for this project. We do one more question. It says that a new machine is cost $500,000 and will produce net inflows of 100,000 per annum for 8 years. Starting time 3. Now, starting time 3, you are not going to get any cash flow from year 1. So you'll get from 3 for 8 years, which means year 3, 4, 5, 6, 7, 8, 9, 10. So it is going until 10 years, starting at year 3. The machine will be located in an old building, which cost $1 million 6 years ago. Now, here you have to consider the relevant cash flows. The machine will be located in an old building, which cost 1 million 6 years ago. Not interested, not relevant. It is an old number. The building could be sold now for 1.5 million or for 4 million at the end of the project. So this is my opportunity cost as of today. This will be considered as cash outflow. Because if I sell the building, I could have got 1.5 million. If I'm not selling the building, I'm using the building, I'm losing 1.5 million cash. So I will consider it as my cash outflow. This is my cash outflow. This is my cash inflow. And because it is a fixed amount for 8 years, I will treat these two numbers, I will treat it as an annuity. That will make my calculations easy. You remember annuities you have already studied. So you've got $100,000 annuity for 8 years. I will multiply the annuity factor with 100K. 4 million will be my cash inflow, because at the end of the project, I'm going to sell this building for project for 4 million. In addition to any cost above, to use the manufacturing process, the company will have to pay a royalty of $1,000 per annum for 100 years. Now, this is a perpetuity. So in this one question, we are using everything. So this is a perpetuity of 100, and this is a cash outflow. We have to pay $1,000. We'll find out $1,000 perpetuity. Starting now for the use of a patent. Using the NPV method and a discount rate of 10%, is the project worthwhile? Now, in this question, we have to consider some relevant cash flows. We have to use the annuity method and perpetuity method. But still, they are very simple questions. I don't expect this is to be an exam style question, because it is pretty much easier. It is very straightforward. So let's see how are we going to do it. Let's make a table again. So first, you've got a cost. This is your cash outflow for 500,000 for the machine. And this is the opportunity cost of that land or the building which you are not selling for this project. You put it as a negative, although you are not giving cash, but you assume that cash is going out from you, because otherwise, if you sold the building, you would have received 1.5. So you are being deprived from this cash of 1.5 million. You are being deprived from this cash of 1.5 million, and therefore I assume that it is cash outflow. So this is my investment in this project, 500,000 and 1.5 million. Then I've got income from year 3 to year 10, 8 years, because it is 8-year cash flow starting from year 3, 3, 4, 5, 6, 7, 8, 9, 10. So I take 10 years factor. This is your 10 years factor. But first 2 years, you do not get anything. So you subtract the 2 years factor. So the factor which is for year 3 to year 10, 6.145 minus 1.736, you get a number which is actually 4.4. 4.409. And this 4.409 is multiplied with 100,000, so you get 440,000. This 4.409 is actually the factor from year 3 to year 10 at 10% rate. Then you are selling the building in the year 10 for 4 million, and this is 10th year discount factor. This is 10th year discount factor, which is 1 over 1.1 because it is 10% power 10. If you find out this number, it will be 0.386. So the cash which you receive 4 million in 10th year, in terms of today, it is only 1.54 million. See, this is how the money loses value over time. You say, I'm going to get 4 million in 10th year. I say, yes, in terms of cash, you will get 4 million. But in terms of value, if I compare it with today, it is only 1.54 million. And then you have a royalty. The very interesting thing now here, royalty was 1,000 and it was 10%. So you remember the formula of perpetuity, P over I, which is P over R. So this is perpetuity 1,000. This is I, which is 0.10. So royalty should be 10,000. Straight value of perpetuity 10,000. But if you notice here, we wrote royalty 2 times. One time 1,000 and one time 10,000. This is the same which we calculated. Then what is this one? Why do you have to put a separate line for royalty for 1,000? Now, this is what I call exam style tip. This is this type of, tips they give in tricks they play in exam. So pay attention to the language of the question. If you go back and now if you see, it says that they have to pay the royalty and the royalty starting now, which means starting today, which means that if you have a timeline of 100 years, this is year 1, 2, 3, 4, 5, 6, 7, 8, and so on. You have to pay 1,000 every year. Year 1, year 2, you will pay 1,000. Year 3, you will pay 1,000. And year 4, you will pay 1,000, and so on. The present value of all of them is 10,000, like 1,000 divided by 10%. But they say now, starting now, which means you have to pay in year 0 as well. Which means that you are in the first year, you pay today and you pay end of the year. So it looks like that I'm paying on 1st January and then I'm paying on 31st of December as well. So this is 31st of December, first year, second year, and so on. But it says starting now. When it says starting now, this is not only in this question. There will be many other situations where they will tell you starting now. So wherever they tell you starting now, it means that there is one amount which is additional. So in year 1, I'm paying 2 times, beginning of the year and end of the year. So when I make a sign contract, it's not that I have to pay them end of the year. I have to pay them 1 now and 1 at the end of the year. So, and whatever you pay now, it has a discount factor of 1, and 1,000 multiplied by 1 is 1,000. So this is the case of this royalty only because of this word now, which means that in year 0. So you have to pay, this is royalty in year 0 now, and then for the remaining perpetuity. And then when you make some are positive cash flows, some are negative cash flows, you make a total, it is $26,100 negative. If it is a negative NPV, straight you say that NPV is negative, I'm not moving forward with this project, and you decline this proposal. This is our, how to say, The first very basic introduction to NPV. Now, we will discuss the advantages and disadvantages of using this method. We will discuss the assumptions and weaknesses of this method. In NPV, we will later on, as we move forward, we will include the tax. What is the impact of tax on NPV? We will discuss the different discount rates. We'll find out the depreciation and disposals. We'll talk about the working capital. We'll talk about the probability and risks in NPV projects, and many, many, many other things can happen with NPV. So this is what we have just learned now about NPV. I would say that it is the introduction, and it is actually just 5 to 10% of the total topic. But that is just a beginning.